Welcome to Fasken's 16th Annual Global Mining Group Seminar Series. My name is Frank Mariage. I am part of the Fasken Global Mining Group, and I'm also a partner in Fasken's Montreal office. Today's webinar, Unearthing Value, How London Complements Global Mining Financing Strategies, is the third webinar in our series of 12 seminars this year. A link of all of Fasken's PDAC events can be found beside the video window. As you view the info slide on the screen, I'd like to provide a land acknowledgement. First Nations, Inuit, and Métis have been present in Canada for thousands of years. These Indigenous peoples have a profound and ongoing attachment to this territory. At Fasken, we recognize that we have a role to play in the ongoing process of reconciliation between Indigenous and non-Indigenous communities here and elsewhere in Canada. We have embarked on the reconciliation journey by adopting a plan with the overall purpose of contributing meaningfully to the reconciliation. Now, I turn it over to my colleague and partner, Leon Miller of our London office, to introduce today's speakers. Leon, over to you.
Thank you, Frank. My name is Leon Miller, as Frank mentioned. I'm a partner in Fasken's London office and a member of the firm's corporate finance and securities group. I'm joined today by my fellow speakers, Peter Lynch from Cavendish and Neil McDonald from Cavendish. Peter is a chartered accountant, having trained at RSM in Edinburgh. He joined Cavendish's corporate finance team in 2018 and has a lot of experience in M&A, due diligence, and other corporate fundraising activities such as IPOs and public market transactions. Neil is a corporate finance managing director at Cavendish. Neil joined Cavendish in 2011 and brings over 16 years of experience advising listed companies on IPOs, fundraisings across both AIM and the main market, with a strong focus on the energy and related technology sectors, and has significant experience on public M&A, advising corporates as well on private equity and major takeovers. A qualified corporate lawyer, Neil has also worked extensively across acquisition finance, project finance, and capital markets, and currently serves as the chairman of the London Stock Exchange's regional advisory group in Scotland. So welcome. Thank you very much, Neil and Pete, for joining us today. So the topic of today's session is how London can complement global mining finance strategies. And I guess before we get into the topic, just to sort of set the scene a little, the market here in London has got off to a fantastic start in 2026. There have been a number of equity fundraisers that have already completed over the last sort of 6 or 7 weeks, and I think more funds have been raised on the market than were raised in the whole of Q1 of last year. So despite all the sort of negative sentiment that there's been around the market here in London for a long time, there are some signs that there's more optimism coming into the market. And this year, as I say, there's already been a number of successful capital raises on the market. A few stand out. Tungsten West raised 41 million earlier on in this month. Yellow Cake raised about, I think it was 130 million. That was an oversubscribed fundraise. Cora Gold raised 30 million as well this month. Atalaya Mining raised 127 million. And last year was also quite a strong year for the London market. There were more IPOs than the previous year. So there's definitely a lot of momentum coming back into the market. And I think there's a general feeling that, the signs are there that it's possible for the right kind of mining company to raise capital on the market. So I don't know, Neil, Pete, if you've been involved in any of these fundraisings this year, and if what you're seeing is consistent with what the market seems to be telling us.
Yeah, I think that summary is correct in terms of the current activity. I think in many cases, what we're seeing at the moment is fundraisings in London being slightly led or cornerstoned by some strategic or specialist investors, and then the more institutional investors following on from that. So there is still that, at the moment, there's that degree of validation, technical validation or industry validation being sought, or certainly being very helpful in the context of larger fundraisings. But I think it's quite interesting how the institutional investors are viewing it, that they are very much, if you look at the past 12 months, there is very much a sort of fear of missing out on the next 12 months. So they want to be part of these raises, and that's probably a relatively new trend in London over the past sort of 10 years, really, in the resources space particularly.
Yeah, definitely. And I think what you'll see with a lot of those companies that Leon referenced there was that these are repeat fundraisings that are coming about from companies that have constantly come back to the market. We can touch on some of the details later on in the session, but what London is positioning itself as is a complementary market that can deliver that sort of intense capital for resources companies going forward.
And some of these projects, I guess maybe 2 or 3 years ago, perhaps wouldn't have been able to raise funds. And we're seeing companies maybe turn to equity, maybe when, debt may have been, a more obvious option for them. And some of these projects are not even fully permitted. So it seems to be quite a big turn in the way that the markets are responding to these projects, and seem to be prepared to back them, which is quite refreshing after quite a few years of decline in the market, to be honest.
Yeah, I think some of the feedback from our specialist sales teams are that the sort of mining funds in particular are seeing inflows into their funds from underlying investors, which is not a trend that's been replicated across the whole London market, which actually means that those generalist institutional investors that Neil touched on earlier have the resources to deploy into mining companies, and they're looking to participate in what is a sector experiencing quite a renaissance.
Yeah, and I think to add to that, I mean, there's two areas sort of driving it. I think there's one, underlying commodity pricing has obviously been very helpful in certain areas, and then two, and the slightly more esoteric commodities, or using the word rare without meaning necessarily rare earths, but the some more esoteric commodities. A general acceptance that these are quite strategic, and they're forming either part of national or international, critical mineral strategies or strategic mineral strategies.
Yeah, I mean, you've seen a number of countries produce critical mineral strategies recently. I was at Chatham House for the launch of the UK's critical mineral strategy last night, and it's following a similar theme about how do we ensure supply chains are secure, how do we diversify those supply chains so there's not a single country risk involved, and how can we use the sort of resources that our country has to aid in that. I mean, the UK's not got the depth of resources that a lot of other countries have, but we do have research capabilities. We've got refining capabilities being implemented, and capital following that. And I think that's a key focus for many countries, but the UK in particular.
And London obviously has got a long history funding mining companies, and the LME is obviously based here. So there's a lot of institutional knowledge and understanding here in the London market, and an understanding of Africa in particular as a jurisdiction, which I think when you look at some of the other exchanges, there's probably a greater depth of knowledge and understanding, and I guess a willingness to invest in some of those jurisdictions that maybe historically or traditionally some of the other exchanges maybe haven't been so strong on. So there is that sort of history in London. I think it has been when you look at the number of companies on AIM at the moment. I think it's hovering just under 700.
Yeah.
And it has come off significantly from what it was at the peak in around 2007. I think it was around sort of just under 1700. So, although there's been a strong performance in the market over the last sort of year, I guess, against comparatively historical numbers, it's still sort of way off. Although I think other exchanges as well have clearly suffered a little bit with the downturn. And, London has suffered in particular due to the lack of, I guess, investment in the industry overall in sort of discovering new deposits. So there's been a little bit of a dearth of new projects. And so we're not seeing any sort of early stage exploration being funded here in London. I think that's been the case for some time.
Yeah.
And there's certainly a bit of a theme that seems to be emerging, when you look at the companies that have been funded, especially even those this year, they are, companies where they are at a fairly advanced stage of development. And there's a clear line of sight to production for investors. And that will play very well, I think, to the London market. Because traditionally investors in London, I think, it's all been about income play. And we tend to be a little bit more sort of less risk. We're a bit more risk averse here in London. So I think that's sort of playing out more and more when you look at these projects that are being funded, which are at a fairly advanced stage of development.
Yeah, I think that's right. I mean, I think it just reflects, the companies that are being funded at the moment. I think it just reflects where the risk appetite is, and it's further up the curve from the sort of pure exploration plays. And it feels like there is good amount of liquidity and good capital available in the Australian market and indeed the North American markets for some of the more early stage ones. I think that if you look to the London listed players or the dual listed players that are listed in London, those that are being funded with material sums, if it's Yellowcake, Tungsten West, Atalaya and others, then you're really looking at sort of later stage developments. But also remember that London has, by comparison, far fewer mining companies on the market than would be the same in Australia or North America, for example. So the choice that fund managers have, if they are UK allocated funds, is much more narrow. So they have fewer places to put their capital, and they are consistently looking for, shall we say, new products or new companies to fund, because that those existing listed companies are pretty well known and pretty well understood. And to aid all of that, there is a very well established, whilst London has a background in mining and resources, there's a very well established sort of analyst pool and a really sort of informed advisory community around it. So I think that's all to the advantage of companies that maybe want to come to London to access more institutional capital.
Yeah, and just to add some stats to that, Neil, I think there's about 170 mining-focused companies across the main market and AIM now in London. So there is that smaller pool from where it was in 2010 even, and smaller compared to the TSX, the ASX, from the sort of exploration companies that you can see over there and the number that's based over there. But saying that, the companies that are raising the capital, where the risk has moved on from that geological risk to the execution risk, they are coming back consistently. And over the last couple of years, there's been about 1.5 billion raised in sterling for mining companies on the London market. And if you look at the companies that have raised that money, those that have raised more than 10 million have come back repeatedly for that, averaging 4, but I think some have come back 12, 13 times, some have come back 2 or 3 times, but they've all done multiple rounds to support that sort of capital intensity required.
Because I think if you look historically, there's been more funds raised through secondary raises on AIM than what has been raised in aggregate at IPO. Yeah. So it's certainly known as a market for follow-on funding. Yeah. And that is certainly borne out, I think, by some of the recent fundraisers. So, and that plays perfectly, I guess, for these sorts of mid-tier mining companies that are just looking to, fund each incremental stage of growth of that project as they go through to production. So what do you think are the sort of, the opportunities for the London market? There's been a lot of changes proposed to the regime, to the listing rules, and I don't know if you have a view on what the sort of opportunities are. I guess we're talking about mid-tier mining companies here in London, and companies that may be looking to raise funds on the market. What sort of opportunities do you think lie ahead for those sorts of companies that might be thinking of coming onto the LSE or AIM?
Yeah, I mean, definitely touch on the regulatory side of things, and London as a whole has moved to make it easier for those companies, particularly with an existing listing, to come to London as a venue and raise those follow-on rounds of capital that you're talking about. Whether that's changes to the requirement for CPRs to be produced, whether it's changes to the sort of reporting requirements, where broadly speaking, I think it's fair to say that if you have a TSX listing or an ASX listing, you're not having to do a significant amount more on a regular basis if you do choose to follow a London listing, but you get the access to that London mandated capital. I think if we move on to one of the first slides that we've got here, there's some stat about how much capital is mandated to London itself. Yeah, it's $476 billion. It's sort of LSE only funds. And the stats at the top sort of reiterate some of the opportunities that we've been talking about. Since 2020, 55% of companies that have done an IPO. Now, that's not mining specific companies, but that is companies as a whole in London have come back for follow-on raises. But that applies to the mining sector as much as anywhere else, if not more so. And it should be getting easier with the changes in the regulatory environment.
And are you talking to a lot of companies at the moment that are thinking of dual listing? Is that are those live conversations that?
Yeah, I think we've got more discussions ongoing now than we have done for a long time from internationally based companies with assets, and they're looking at how do we get these funded? What are the opportunities? We need a significant pot of capital to turn this from a drilling story into a delivery story and a production story. They're not all going to sign up on day one to an engagement letter and proceed with the transaction, but we've certainly got a lot of live conversations on that front, and they're interested to see what is investors' appetite like, what are they looking for, what's being funded, and how do we get the comfort that if we do pursue an opportunity like this, that it's actually worth it at the end of the day. I think that is whereby introducing companies to investors at an early stage, before significant costs are incurred, etc., means that they've got a bit of confidence whether or not this is worthwhile pursuing.
I mean, I think because there are far fewer, obviously, mining companies on the London market, that one of the advantages is that you do stand out from the crowd potentially if you're on the market. So for those sort of Canadian mid-tier companies that might be looking accessing another pool of capital, a deep pool of capital in London, that it's something that perhaps more now than maybe a few years ago is going to be at the forefront of their thinking. There are lots of advantages, and the new sort of rules are going to make it, I think, a lot easier for companies to come on to the London market. I mean, you touched on, Pete, the CPR requirement, and there was a technical note from the FCA last month that seems to be saying that if you've been reporting on your resources and reserves on a regular basis, on an annual basis, that you're exempt from publishing a CPR, which I think, and that's going onto the main market, but that I think will make it a lot easier, clearly, in terms of take some of those frictions out for coming across onto the LSE, which is quite an interesting development, really. So there should be lots of opportunities potentially flowing from, that sort of change. And the listing rules now have a specialist segment for overseas companies that want to access London as a secondary listing. And so, I think there is now a dedicated category on the London market, on the main market, which is pretty light touch. It's sort of modelled on the standard listed segment, but only available to non-UK issuers. So it'd be interesting to see if that sort of results in a flow of overseas companies coming onto London, and they should be able to list and run their business with pretty much minimal additional regulatory burdens. It's designed to be a very light touch listing category. That's one to watch out for.
Yeah, agreed. And I think that will help from the regulatory side of things and the regulatory burden that goes with that. What does go with that is because the investors in the space in London have this scarcity of opportunity. They do a lot of work on where they're deploying that. So to go with that, you do need to spend the time in front of investors, actually meeting them face to face, talking them through the assets, giving them time to get comfortable with it. But once they are comfortable and committed to that capital, then they seem to be long only sort of holders. They're happy to support that. So it's worth putting in the effort up front with those investors.
I think there also seems to be a general trend from a regulatory environment, both main market and AIM, to sort of facilitate or better enable transactions that deliver material growth. So certainly from an AIM perspective, we've seen recent rule changes around which were effective immediately around what would previously have been regarded as reverse takeovers, which for everyone's benefit would have previously required filing of prospectuses, equivalent prospectuses, so admission documents, which would have required 43-101 CPRs, accountants reports, legal due diligence reports. Actually, AIM has looked again at its rule book and is keen to be seen as a growth platform. Therefore, if you are doing something which is not a fundamental change of strategy, then that wouldn't necessarily be a reverse takeover. And we've already seen with one of our clients in the energy space the ability to materially scale up their operations by, in their case, acquiring significant production assets without having to go through that reverse takeover loop. So I think that the regulatory environment is improving all the time in London, is being specifically more permissive of transactions and deals, and just removing some of that friction and the regulatory hurdles that you might otherwise see.
Yeah, I mean, it's moving, I guess, towards a disclosure-based regime increasingly. So it's on a sort of, the market overall is on a sort of deregulatory drive, I suppose. But a lot of that grit in the system has been removed, if you like, around having to go back to shareholders for approval, which and the listing rules have removed all of those requirements, of course, for significant transactions to be approved by shareholders, and that always, I think, put UK listed companies at a significant disadvantage when sort of competing in M&A processes, for example, against private equity or issuers on other exchanges that were not subject to those very stringent requirements. So removing the requirement for shareholder approval for M&A, for significant M&A, I think is going to really boost the market. It's going to make it a lot easier for high growth companies to execute their strategy on the main market a lot more easily. So I think that is a good thing. And there are lots of other changes as well related to related party transactions, which have also been removed. Again, removing some of the shareholder requirements for the requirements for shareholder approval for related party transactions on the main market and on AIM. So making the regime just a lot more user friendly and business friendly for high growth companies. I think is definitely the direction of travel. And I think for when you look at the other changes on the main market around the eligibility requirements for coming onto the market, I think there's lots of opportunities for companies with alternative business models to come onto the market. You no longer need a 3-year revenue earning track record to access the main market. or historical financial information over 75% of your assets, and you're no longer required to run an independent business. So I think that opens the door to companies like royalty companies that don't have full control, that are highly acquisitive, entrepreneurial in the way they're running their business. So it'd be interesting to see, I think, what opportunities those changes that came into force in July 24. So those have been in force now for just under 2 years. But I think that will open the door to a lot of other companies with alternative business models in the sector.
Yeah. And I think it should all be looked upon as well against the backdrop of an improving London market more generally, and an improving sort of economic situation. So I think the London market has struggled from redemptions, or funds have struggled rather from redemptions over the past 2-3 years. Again, I think we've seen that bottom out. It's particularly as regards resources specialist funds. As Pete said earlier, we're now seeing significant inflows. So all of these trends are happening at, I think, the right time for resources companies, and specifically to take advantage of the opportunity.
Yeah. And I think if we move on to the next slide, it sort of covers some of the types of investors, to pick up on Neil's point, that are participating in the market, because you get access to that generalist investor pool with names that you might have come across all over the world, but they have UK mandated funds. They are looking to participate, and a number of them are participating quite actively in recent fundraisers for these sort of companies that we're talking about, that are maybe at this point of DFS's construction or early production. But you've also got the sort of sector specialists that are sitting here looking exclusively for resource companies, coupled with the sort of participant sovereign wealth funds that see the London listing and the profile that it gives them, and the sort of global view that they have, and they're willing to participate in these fundraisers, support those companies in the long term for the advancement of the projects. And it's worth saying that a number of the generalist investors that you can find in London are overweight in the mining sector just now, because they see that there's significant potential for that over the next 5-10 years. They're looking at a full cycle of how the mining industry develops, as opposed to a short-term sort of profit.
Do the generalists wait for the sector specialists to cornerstone? Do they wait for the sector specialists to validate the projects, and then is that your experience?
I would say that there can be a bit of that. That will give them a bit of validation and de-risk it from their point of view, but they're looking generally to de-risk the elements that they maybe don't understand as well, which could be the geology, which is whereby once you've got to your DFSs, once you're in construction, they know that that's an execution risk. They understand that timelines will move on these things, and capital budgets will change, but they have an improved understanding of that, as opposed to the drill bit in the ground sort of exploration work, which they're not quite sure of what exactly they're backing. So they're looking for something to de-risk it, whether that's sector specialist funds, or whether that is just the advancement of the project, clear milestones that are being laid out and being met.
Yeah, just echoing that. I think the earlier you move in the project life cycle, the more requirement there will be for technical or strategic or industry validation. As Pete says, I think as you move through that, closer you get to cash flows always helps attract. And then underlying commodity pricing helps as well. So people are looking at, have they missed opportunities in gold, for example, or copper or silver? Otherwise, well, where does one look next, and what are the other commodities that one would look to next, where we could see a similar move over a 1, 2, 3 year period?
Yeah, and it's worth just on the left hand side of this, there's some just demonstrating that the investors. We've got some UK names up on the right hand side of the screen, but the investor base in the London market is an international investor base. There's a high proportion of international companies on the London market, but there's also a high proportion of international investors coming into these businesses as active long holders.
And what about the sovereign wealth funds? Are you increasingly seeing the sovereigns investing in these projects?
I think there's more interest in taking equity stakes than there has been. Again, their risk profile is probably slightly different. They're looking for something slightly different from the generalist investor or the sector-specific funds. But once they are in there, there's obviously a deep pool of capital that you can take along for these repeat raises. They know what they're looking to get out of it and what the advantages are for them. So they're happy to follow their money, I'd say.
Good. Do you want to move on to the next slide?
Yeah. This just covers some of the stats that we've sort of talked about in the preceding discussion. The pool in London for mining companies has shrunk. The investors are therefore looking at that smaller pool and thinking, well, how do we get confidence in what we're investing in? How do we de-risk that? And once we're in it, how do we know that we're there for the long term and we de-risk that proposition as the project advances or the company becomes bigger? Might be looking at making asset purchases once they're in production and that type of thing. But it is good to see that although that pool is shrinking or has shrunk, that there is still that international access we've talked about. 12 TSX to LSE dual listings recently since 2020, and there's 32 Canadian companies on the London market just now, with a sort of combined market cap of 75 billion. So that just emphasises the point I was talking about earlier. There's that international base in London, and investors are happy to sort of work through that. They'll do their work on the projects, they'll do that work on the management team and decide if this is a proposition worth getting involved in.
I think on dual listed opportunities generally, we've seen it over the past 10, 15 years across resources and energy, and again, both with companies with primary or dual listings in North America and Australia, for example. And there is a nice balance to having a dual listing in any of those jurisdictions, really, with London, in the sense that they are slightly counter-cyclical. They operate on a slightly different basis. Typically the North American markets in the small mid-cap space and in Australia as well are slightly more retail-led, so shorter term investment, whereas London provides longer term, slightly more macro trend institutional investment. And we've found on a number of occasions where one market has been weaker, the other has been stronger, and there's a little bit of a hedge there.
The hedge for jurisdictional risk, I guess, for each exchange. So that's definitely, but there are obviously some complexities around dual listings as well that you have to navigate. So I think there's also, all of that you've got to think about with additional layers of regulation. And sort of thinking around your corporate governance policies and having to sort of tick two sets of boxes and timing of the release of announcements, etc., which can complicate things. But I guess it does give you access to multiple pools of capital and different different profile of investors in each market. If it's more retail in Australia and Toronto, maybe, and more institutional here.
We tend to find that the dual listings, again, from North America or Australia with London, those other exchanges, the North American exchanges or the Australian exchanges, tend to be sort of super equivalent in their regulatory requirements to what London would ask for. So therefore, it tends not to add on. There's definitely administrative and other complexity there in terms of how one addresses the market and communicates with the market. But it tends not to be material in the sense of additional disclosures, additional work streams, and so forth. So, I think London does helpfully sit just below where the bar would be set on various regulatory disclosures, albeit, as I say, there are some administrative.
And there's quite a lot of TSXV companies actually that have dual listed maybe onto AIM, and then they sort of come off TSXV actually. We've acted for a few over the last couple of years. They come off the TSXV onto AIM and then maybe migrate up onto the main market. So that seems to be a path fairly well trodden, I think, over the last few years. And it tends to be that there's often very little liquidity in one exchange, and then it just becomes sort of very unbalanced, and so they decide to delist. But we've seen a few of those.
I think one of the key things we've seen in where dual listings have been successful is where capital has been raised contemporaneous with or soon after the London listing, for example. So you really need to get some liquidity into the secondary market, quite quickly. Otherwise, it's very difficult to make a successful dual listing. So that's not to say it has to be immediately, but I think that there are numerous examples where it's been done within a sort of 3, 6, 9 month window, and that feels like it works. Companies which, and we've acted for them in the past who have dual listed but have said, well, look, we don't need additional capital right now. At the point in time when they need it, they find that the market is not necessarily as receptive to it because there's no liquidity. And that then becomes a sort of key hurdle for institutional investors to make an investment because there isn't already that liquidity.
And also the issue is often neglect one of the markets, actually, if they haven't raised capital in particular, so they don't make the effort to come over. And there's very little research. There's much less research now in the London market for various reasons, as you know, than what there perhaps once was. So it's hard for retail investors in particular to access research. But there is that tendency to neglect, I think, one of the markets, which makes it incredibly difficult to then go and raise capital, as you were saying.
Yeah, exactly. And I think that goes to the sort of institutional attitude whereby they're looking to deploy capital. Once they've made a decision to make an investment, they're looking to deploy capital in their unit sizes, whatever that is, and take meaningful stakes in companies, being 1%, 2%, 3% at a time, or bigger in some cases. And sitting and buying on a market where there's not any liquidity, that becomes very difficult to do. So yes, I think you've got to have a clear rationale about why a dual listing would be a suitable thing to do. What are you looking to complement your existing sort of source of liquidity with, and why does it suit? If we move on to the next slide, there's.
I just wanted to ask actually on that slide where we're talking, there's quite a sharp decline in the number of mid-market mining companies. How many of those have just come off the market to move on to other exchanges, or how much of that is a result of consolidation, sort of M&A? Because I guess that's obviously been one way that mining companies have been able to sort of chase additional resources, reserves through M&A. What's the reason for that?
Yeah, a mixture of both, but there has been a lot of public M&A in the London market and for the last few years, and actually, which obviously depletes the sort of investment universe as such for the institutional investors here, but it does also mean that they've got cash that they are sitting on coming back into their funds that they're looking to deploy. Ultimately, they're paid to investing in companies. That reduction in numbers will be a combination of two sort of effects, but most of it will be public M&A or assets being sold off, certainly, and then the companies being wound up. But I think all I was going to say on the next slide is, it's an example of how a sort of capital strategy develops over time. Amaroq was successfully funded in the TSX at the early stage of its exploration venture, sought a dual listing in London on AIM, raised capital alongside that. That capital has been long-standing. It stood through the sort of deferral of the development plans in 2021. But then there's been multiple fundraisers, and they've added a NASDAQ Iceland listing on with additional capital raise. So there's clear rationale on both those side of things. But the management team, there's delivery of their sort of plans over the long term has obviously led to that company growing. They've just announced that they're planning on moving to the main market. And to your point earlier, they're going to voluntarily delist from TSXV because they've seen where the sort of liquidity follows as the journey has followed that company.
Want to go on to the next slide?
We can touch on Yellowcake. Whilst not a sort of mining operator as such, it has exposure to the uranium pricing. They're pure play uranium company. They've had, it says there, £800 million of fundraising over their sort of timeline on the market, and this really demonstrates that liquidity and capital will follow thematic and thematic plays in the sector, regardless of the type of structure. So your point about talking about royalty companies earlier, investors are willing to support those type of businesses and get the exposure in different formats, and follow with significant capital all the way through. And now their sort of long-term supply agreement based in Kazakhstan, so there's obviously a bit of jurisdictional understanding that needs to go in there. But again, it demonstrates that those sort of London investors, once they're brought into a proposition, they make sure they understand it and they follow through. And then the final case study that we've really got here is Atalaya, which again was a TSX listed company, but sought a London listing as well. And really, they've developed that story over time with a couple of significant fundraisers and progression of that business through from being an AIM company through transfers to the main market, index inclusion and the liquidity that follows that. And they've proved their model by becoming a dividend-paying mid-tier producer, which wasn't always the case, but shows how investors will follow that money. I mean, again, stats there, they're £1.5 billion business these days, but they've raised 350 million across both AIM and the main market, with their £130 million fundraise this year topping that off.
You mentioned index inclusion there, so I was just going to jump in with one point, which is actually for overseas incorporated companies who wouldn't necessarily qualify for indexation inclusion and the main FTSE indices. I wouldn't necessarily be too hung up about that. We've looked at it for a number of overseas listed companies, and to the effect of index inclusion on liquidity and share price. And actually, we don't see any direct correlation. It is much more stock specific than a general index inclusion is good, index exclusion is bad. So it's certainly not anything I would have as a material factor in anyone's considerations for seeking a London listing and a main market listing, for that matter.
So it hasn't stopped anyone coming across to London.
No, I think there is a perception, and I think a lot of our work in the past with potential clients has been to slightly prove the negative, which is always quite hard. But if we look at a basket of peers, for example, some of whom are included in the indexes, and some of whom for jurisdictional reasons are out with the main FTSE indices, as I say, there is no direct correlation that we can evidence, and actually it is therefore, whilst there might be a perception of it being an important consideration about a London listing, I'd be pretty keen to assuage anyone's concerns about that.
I guess because of the investors that are going to be attracted to these companies are going to be specialists all the time. They're going to really understand the project. So that's going to be the capital that's driving the performance, the share price performance as well, I guess. So, next slide.
Yeah, really, this is just summarising, the sort of nature of what companies are looking for when they come to London. Exactly to Neil's point, doesn't once mention index inclusion, but it does give access to UK mandated capital. It gives you that ability to repeatedly raise capital on the market and develop your assets in that capital intensive phase that mining companies will go through. And it also gives you that visibility and relevance in an international sort of environment with the investor base that's there. It comes with that, potentially that broader ownership that companies are looking for and liquidity that follows that. But again, that I would take you back to, you've got to have a clear rationale about why you're looking for that dual listing. What is it that you're seeking from coming across? Is it the capital to help you develop that asset? And therefore, what can you explain to investors is your sort of timeline, your milestones, what you've delivered to date, and how can you give those investors the confidence that you're the management team that will continue to deliver on that? Because they understand, I think the investors understand that, as I said, construction can take longer and cost more. Regimes can change in terms of sort of mining royalties, etc., that countries may seek to take. We act for a company based in Zimbabwe who had a bit of a false start with their changing taxation regimes, etc., and have come back and have acknowledged that there was a bit of a mistake, but they have changed it subsequently, but to the point whereby it only kicks in when there is probably exceptional profits potential being made.
Yeah.
But investors will understand that risk. They understand that that's not necessarily in the control of management teams of these assets.
Yeah, comes with the territory, I suppose.
Exactly.
But I think to your point, Pete, these companies have to have a very clearly defined sort of equity story to sort of be able to bring institutional investors along with them on their sort of capital journey. I mean, we find that a lot of clients look to do a fundraise in conjunction with some sort of corporate action, some sort of M&A activity, which really sort of helps define the fundraise and the story behind it. So, that certainly helps. But and then what would you say are the sort of big mistakes that companies make when they're looking to access London? What are the sort of things that can be underestimated, would you say, when they're going through the process of trying to access the London markets?
Two things for me, Neil, you might have a different view, but two things for me certainly would be expecting that investors will follow your story without you putting in the legwork to actually get the attention to go out and sit with them, talk them through it, make sure that they understand everything that they want to understand about that story, which can take multiple meetings. It can make sure that you're speaking to research analysts who understand it and can publish notes on the company, and putting in that legwork. And the second thing would be having an equity story that changes consistently, because investors want to know what they're getting into. And if they think that you're constantly changing the goalposts and looking to sort of change the narrative that they think they understand, then it'll just immediately put them off. I think that sort of credibility from an investor standpoint.
So a simple sort of investor story is the message.
Yeah. Certainly consistent. And clear demonstration that you are delivering on the story that you are making, because these processes, dual listing processes, or even IPO processes, just for a standalone business, are not quick necessarily. Investors will want to see you 2 or 3 times during that process. They'll most likely want to see you 2 or 3 times before you ever look to raise capital from them. And they want to be able to look back and say, okay, well, these guys said that they were going to do X, and they have delivered that, or they're still on track to deliver that.
Yeah, just expanding on those themes, I think, which is, don't underestimate the amount of education that is required for a new equity story. That can be, the above ground risks, the below ground risks, the commodities themselves. Some are more opaque or esoteric than others. So, engaging with an advisor or a broker who will do that education process with you. And again, don't be under the impression that people will write checks after 1 or 2 meetings. They will want to continue to follow you and monitor your progress. Effectively treat it like a brand new listing in some extent. And then secondly, Pete mentioned about sort of consistency and delivery. Delivery is absolutely critical. So, once you are committed to a dual listing, or once you are dual listed, delivering on milestones, not over-promising and under-delivering, which is the fastest way to, see something, certainly see a share price fall away. So, those themes go across sectors. They're not specific to the resources sector at all, but they're incredibly important as you look at a potential dual listing.
I think that the next slide just wraps up a few of those key things into sort of clear messages, and it is really about execution, executing your plan, and the plan that you've communicated will help you deliver long-term shareholders into your registers, so you can support these repeat follow-on capital raising. And as your business develops, you'll have those holders on your register, but also hopefully attract new investors who come in with different risk profiles and different different attitudes towards jurisdictions. But there is a broad investor base here. I mean, you touched on the core fundraise earlier, which is Mali based, I think, which is obviously from a jurisdiction is relatively high risk just now. And lots of developments going on in the country, but they still managed to raise their money, which is supported. But that, again, that's about finding the right investors for that particular asset, that particular company.
But that's a company that I guess 2 years ago probably would have really struggled to raise any equity in London. So it's a good example, I think, of how the market seems to be turning. I mean, I wonder how it's going to play out over the rest of this year, if the momentum is going to continue. Hopefully it will. But I guess there's a limited universe of companies that are candidates to come onto the market. And whether or not, one of the effects of the rule changes on AIM in particular may be to see a little bit more of the earlier stage companies beginning to be funded again, which I think, could be one outcome. I guess once, the market's running a little bit hot at the moment, and I think there is some commentary around that at the moment, that maybe there will be opportunities for some of the earlier stage companies that once upon a time probably were finding it easier to raise capital here in London. But I guess, it remains to be seen. And the AIM rules haven't yet, or the new rules have not yet been published, as far as I'm aware. So it remains to be seen exactly what shape they take. But we have some idea, I guess, of the direction of travel from the feedback paper that was published by the London Stock Exchange just before the new year. So I think we're hopeful that it will, I guess, realign the market as it needs to be to distinguish itself from the main market. And traditionally it was always obviously the junior market and perceived to be a lighter regulated market. And it needs to, following the rule changes on the main market, I guess, reposition itself as a lighter touch, more flexible sort of platform for high risk, high growth companies, driven, underpinned by the principle of caveat emptor, which I think really does apply to AIM
and
in particular.
I think that the stock exchange has recommitted itself to that sort of ethos, if you like, and the thing that will be an anathema to say North American companies would be the nominated advisor regime, for example, which is commonly raises questions and probably draws people towards the main market, but that's not necessarily required as an ongoing role. But actually, the AIM team has looked at the role of nominated advisors and has seen that over the past little while they've become increasingly sort of compliance driven and probably therefore much more risk averse, and they've tried to tilt the balance again through the recent guidance towards helping companies grow, and that a nomad should be there as a corporate finance advisor first and foremost, rather than as a sort of regulator in local parentis of the stock exchange. So again, I think that's a sort of slightly thematic change that should make the nomad system, which is now well established, just 25, 30 years in existence, but it's not replicated in any other regulatory environment in the world, I don't think. But it does work well, and we sit here as two nomads, so we would say that, wouldn't we? But I think it is. It is something which, if it is gotten right, and you have the right balance of commercial advice alongside sort of regulatory oversight, it can be massively helpful. It prevents a company from having to directly interface with a regulator. It's dealing with a commercial advisor in place of that. And so,
you must be relieved you're not going to have to spend so much time on the compliance aspects of the role. So leave that to the lawyers, I suppose.
Yeah, I think so.
And you see that with some of the points raised in the feedback paper around, trying to minimize duplication of work. I think the regime up until now involved a lot of duplication of work and effort between the advisors, and especially looking, at the admission process where, and I think it was always obvious to a lot of us that there was a lot of duplication of work between the corporate finance advisors, the nomads, and the lawyers. And I think there's a real concerted effort now to try and eliminate that, to not only sort of speed up the process for listing on the market or admission to AIM, but to reduce cost as well, because I think the costs had become a little bit disproportionate. And then, the overlay of regulation, like the market abuse regulation that, duplicated some of the AIM rules around price sensitive information. And there's always a little bit of confusion, I think, in the market about who was actually responsible for advising on certain aspects around price sensitive information. But I think it looks like they are going to leave that to the lawyers, I think, and leave the nomads to advise on the corporate finance aspects, I guess, of that that piece of work, which I think makes sense.
Yes.
But it was a bit of a mess, I think, and so there is scope for sort of streamlining, I think, rules, which I think it's the expectation is that will be addressed in the revised rule book.
Yeah, agreed.
Yeah. But I think even going through the admission process where verification, for example, I felt there was often too many advisors perhaps poring over it than perhaps there needed to be. So trying to speed up the admission process, I think, is definitely the goal of the London Stock Exchange with the new AIM rules, and that certainly comes through. It's a message that comes through in the feedback paper, and the admission documents itself, which was based historically on the sort of I guess it was the pan-European prospectus requirements that drove the content requirement of the admission document that I guess increasingly was really out of step with the nature of the business, the businesses coming on to AIM, which tend to be high growth, quite sort of entrepreneurial founder-led companies, and trying to sort of streamline the content requirements, I think is gonna really help. And the feedback paper talks about using, I think, digital technology and trying to just make it easier, allowing more information to be cross-referenced incorporated by reference into the document. We're going to make it a much shorter document, and I think a document that's going to be much easier for investors to read and understand, which I think it's all part of that communication piece that I think the LSE is also very focused on, trying to sort of get the message out there that AIM is about supporting high growth companies, and sort of it's a branding exercise as well, distinguishing it, I think, from the main market, so it can really rediscover its identity that had perhaps been lost a little bit, where the regulator, not only the London Stock Exchange, but the FCA had taken, I think, an overly stringent approach to many aspects of the way the market was regulated. So I think it's a good thing, and it should hopefully promote a lot more activity, make it easier for companies to come onto the market and ultimately raise capital.
Yeah, definitely. Ultimately, I think any company looking at a dual listing in London wants it to be complementary to what they already got in place. So making it as easy as possible for them to get on and actually adding value to investors who are using those documents, I think will be well received.
Absolutely. And even with companies looking to dual list onto AIM, I think this sort of fast track, or supposedly fast track route, or the AIM designated market route, had become very cumbersome. And we worked on one, in fact it was with your London office last year, and it felt like going through a whole IPO process, when I don't think that was ever the intention behind the rules. And so to make it a genuinely fast track process, I think will be welcomed. And I think the LSE is also looking at broadening out the eligible markets, so not just looking at the top tier markets, but also the more junior markets on other exchanges, which I think will be welcomed. So I think that will again open up another pathway onto the UK capital markets, I guess, alongside the overseas listing category on the main market. Although I guess it's worth pointing out that there's now a minimum £30 million market capitalization requirement on the main market, which I guess has probably shut the door on a lot of early stage explorers coming onto the main market. So I guess AIM is probably more likely to be the more likely sort of pathway onto the London markets for those sorts of companies.
Yep. And it's worth just saying on that point, and we touched on it earlier, but the comparative numbers of resources companies, for example, on AIM versus some of the other exchanges, TSX, TSXV, ASX, is very, very small. So, I say again that, the investors are continually looking for new product, new investment opportunities, and particularly where something they may perceive something as being undervalued on its home exchange, and there's a genuine value play. So it is interesting for us always as an advisor. It's always interesting for us to look at other exchanges to see how companies are performing, how companies are valued, and how they compare to the peer group here in London, as to whether or not those are attractive investment opportunities for our clients.
I mean, the London market has always been a little bit historically undervalued, I guess. I mean, we hear from clients that they're looking at M&A here in London because they see so many opportunities from a valuation perspective. And I mean, I guess it does make it hard on the one hand if you're looking to raise capital here, if you are valued at a 30% discount to maybe in other jurisdictions. And that is a challenge, I guess, that remains to be sort of solved, I think. But when there's less liquidity, I guess that will depress valuation as well. Yeah.
So I think that's the undervaluation of London is across all sectors, or has been in the past 2-3 years across all sectors, and has been slightly structural, and it's been driven by that sort of weakness in the underlying investment market for some time. We talked earlier about the problems that some of the funds have had with redemptions. So I think that has been structural discount. I think that is now reversing to the mean. I think almost all exchanges are undervalued by reference to the US. But in commodities and in resources, I think one can draw a more clear line of comparison between commodities wherever they may be. And therefore you can look for some of those opportunities of genuine undervaluation on other exchanges, which might be rectified by seeking additional liquidity elsewhere.
I guess the other point to note is there's a renewed impetus to get retail investors involved in the London market, and it's quite commonplace now to see retail investors participating, and I think a number of these fundraisers that we were talking about earlier and that you've included in the slides will have all had a small retail component. So that's becoming, although I guess London's next to known for retail investors, that's coming more and more to the fore. And the sort of prospectus regime, which came in, there's a new prospectus regime here that came into force last month. That I think one of the effects of that will be to encourage a lot more retail participation at IPO on the main market and also on AIM. So a lot of the triggers for the requirement for a prospectus have been removed, which again is going to make it a lot easier for companies to operate here in London, and it will be more cost effective. But encouraging retail investors is has been a big area of focus, I think, and one of the results of this of the prospectus regime will make it a lot easier for retail involvement. So I think that's only going to be helpful for liquidity in particular.
Yeah, definitely. And I think companies, certainly in London, are getting better at communicating with those retail shareholders, whether it's through the announcements they're putting out, but also the supplementary media that goes with that, whether it's videos, whether it's short clips about what the impact of announcements is expected to be for the company. They are becoming increasingly up to speed with communicating with those retail shareholders, which helps that engagement.
And there's a number of other sort of regulatory changes that are going to really, I think, help stimulate activity on the market. There's the dual class share structures that are now can be accommodated on the main market and also on AIM. And I think that will support sort of founder-led businesses. And I guess a lot of these changes are to enable, the UK markets to compete with the US in particular. A lot of the changes are designed to sort of encourage, I guess, institutional money to come into UK equities. But nevertheless, I think that getting more liquidity, more momentum into the market will ultimately help, Canadian mid-tier miners that might be looking to access the London markets. I think it will, only help the, all market participants ultimately if these changes, these sort of deregulatory changes that are coming through, moving towards this more sort of permissive regime is definitely going to help everyone, I think.
Yeah, I mean, I think I've probably been guilty in the past of oversimplifying it by saying that, I've never really seen somebody, decide to list or not list because of prospectus rules or because of how difficult it is to write prospectus. I think that's probably slightly too clumsy and too simplistic. I think certainly, as we described earlier, there is some grit in the system that you can work through. Ultimately, I think where people choose to list and why people choose to list is because of weight of money, and weight of money drives valuations. And those are the things which will ultimately, win the day. And as Pete covered earlier on in the presentation, there is such a weight of money in London to be put to work in UK listed stocks that there ought to be a supportive environment for any company, whether it's a brand new listing of a UK listed company, of a UK company, or a dual listing of an international company. But we are ironing out some of these hurdles. It appears, and that is great. The weight of money is the key thing that will ultimately deliver successful listings.
Yeah, definitely. And strong commodity pricing.
I think is
clearly.
Definitely does help.
Good. Was there any other slides? Or
there's a couple more.
Yeah. We've sort of talked about some of these. These are the regulatory changes. So the listing rules were revised about just under 2 years ago. And the AIM rules are currently under revision. And we're waiting the new sort of rule book to be published. But I think, going to your point, Neil, about the weight of money, one of the points that comes out in that feedback statement is around how the FCA perhaps got some of the messaging wrong around liquidity management and after the Neil Woodford sort of debacle, I think I guess a lot of institutional investors felt that they almost couldn't invest in AIM anymore, that it was not liquid enough as a market. And I think the FCA have come out and sort of clarified helpfully that actually that wasn't the intention. But I think a lot of capital, there has been a capital flight, I guess, that it's coming back now. But some of the statements from the FCA to clarify that, I think, will be helpful, I guess, to get a bit more liquidity back into the market.
Yeah. And then I think the final slide is just for those of you who haven't heard of us, is a very, very brief snapshot of Cavendish, which is a UK broker and investment bank, covering all the service areas one would expect, but particularly involved in the equity capital markets and private M&A. So our equities business and our private M&A business is also linked internationally through our membership of Oakland. So we do have some boots on the ground in North America and Canada. You can see some of the stats there. We're particularly active on the ECM side of things and capital raising here in London, but also increasingly active on cross-border M&A. So I think one of our most recent pieces of public M&A was for a Canadian listed business in the energy space, acquiring an AIM listed business, and then relisting the enlarged entity back here in London. And we had the market opening ceremony for that admission to London this morning. We do step out from the UK, and we are interested in companies across the globe. It's part of the sectors that we're in that we have to look internationally. So that's just a very brief intro to Cavendish and I guess our details will be available if anyone has any specific questions.
Great, thank you. So I think that brings our session to a close. I think it's clear that it's good to hear there's a weight of money in London ready to be deployed. Lots of opportunities for mid-tier mining companies in Canada to come across to access the London markets. A lot of momentum at the moment in London. There's a new regime change that I guess is going to help momentum as well. But I think this year is going to be a solid year for the market, and hopefully it will continue.
Very good. Hopefully.
And it's worth saying, I think all three of us will be at PDAC next week.
We'll be at PDAC next week. Yeah.
Very good.